All right, we are live. Monday market update. We are live on March 3rd, 2025. For anybody who's following mortgage rates, we've had a few good weeks. We'll talk a little bit about mortgage rates, the direction of those, what the Fed is up to. I'm excited, honestly, Nash, to talk about kind of market dynamics and what I'm seeing, hearing, and feeling, being someone who's actively involved in real estate transactions and structuring of mortgages and whatnot. So thanks for joining me, brother. How the heck you doing?
Yeah, man. Good to be here. Excited. I love coming in, talking mortgage rates, investment stuff, bonds, securities, Fed, especially when we've had, some good news for a significant amount of time now going forward. We're starting to get to that exciting moment where things are trending in the right direction for long enough that we start to see some movement in the market. So I know why you're excited, and I'm excited too.
Yeah, it's always funny too. As much as I get mud or tomatoes slung at me when rates are going higher, I want to hear the praise. I want people to thank us for all our hard work, for mortgage rates coming down, for the financing portion of homeownership being more affordable, because as you and I both know, we've got a huge influence over that.
I'd like to know how you take credit for that.
I don't know, but it's interesting dynamic when you have these client conversations. So I don't know, where do you want to start? Should we start with things that are going on in the mortgage market, look at some charts and do the nerd stuff? Then we can talk about it.
Let's do a quick weekly recap here on, what we were talking about last week, where we were seeing, where we were pointing the finger at things to watch. So talking about the charts and all the economic news from last week, the big day that we were looking at was Friday. That was the caution day because we had core PCE coming in and we had the month over month and the year over year. And the interesting thing there was, we expected the month over month in January to go up from 0.2% to 0.3%. It hit that right on the mark. The year over year, we were expecting to go down from 2.8 to 2.6, and it hit right at 2.6. So the interesting thing getting into the end of last week is we started seeing, bonds, trade favorably. We started seeing the yields on the 10-year go down throughout the week, which usually means investors know something that's coming that we don't. It was a great big old fat nothing burger with cheese. So we hit right on analysis and we just kept that smooth slide going all last week and into today. And, if I can count this morning as part of the recap, it's really been interesting to see, we opened up, losing 15, 16 basis points, nothing crazy, the kind of, intraday changes that don't move the needle. It's just normal movement. But then we reversed and now we're actually up 4 basis points. So a 20 basis point reversal. And it happened a couple of times last week where we saw the same thing. We saw, start a little in the red and then finish green. So, it's been interesting watching the markets react and watching bond prices surge, but that's our weekly recap. Nothing real crazy to talk about. Let's jump into the nerd stuff and see what it looks like on FedWatch. So getting into the next meeting, it is March 19th. So we are 16 days away from where things are going, but let's see let's get the charts pulled up here. Where the interest rates, let's see, where's Caden in my chart? I got no chart. Well, I don't need a chart. Maybe we lost
working on it. Do you want to start with there's
okay.
the March meeting and the overwhelming.
Here we go. This is what I wanted. This is my favorite chart. I love this chart. So getting into where the March meeting is coming in 2 weeks, I love the fact that this blue line, again, I only care about the blue line. The other lines will catch up to it. They're not generally as accurate, but look at that. You almost can't see where the blue line is because it has come down so severely in the last week and a half. We've got an average 30-year fix right now at 6.74%. That is a 5 basis point change from the close of business on Friday. I mean, that's awesome. Like, you look at these little hills and valleys, we're heading in the right direction. Now, we're still pretty far away from the 6.5, 6.25, but we're moving in a nice direction here. And, that makes me smile. What about you, Matt?
Yeah, I mean, I definitely know that when I have the conversations with clients, and they're like, well, I was hoping I could get this thing for 740. I'm going to end up, 756 is where the seller's going to be at price wise. And I go, well, you want to hear the good news? The last time we ran numbers at 740, the payment was this. You're going to pay 756, but we're a quarter lower on rate. So your payment's actually less than what you thought at that lower price. And, that's a good conversation to have. It's a good thing to deliver to clients. Most great mortgage brokers, I would assume, are trying to not overpromise, So we, generally speaking, are looking at the whole picture in the mortgage, and, maybe we pin 7% or 7.25% while they're out shopping. And that's a good guesstimate of where rates are going to be, knowing that they're changing every day. And when they do find a home and do get into contract is when we're actually going to look at the rate sheet, figure out what price and what rate makes the most sense. So when those are trending downwards and the last thing they saw is higher than what you're able to present and lock them at, it's fun on our side.
Yeah. I mean, I'm looking at real-time chats right now in one of the groups that I'm in. That's all about the nerd stuff. And, a lot of the consensus right now is, hey, just going to take the small victories. And like you said, the small victories are affordability. It may be $20,000 on the purchase price that you just got. Someone may have just gotten a little bit more room on their deal. And for some people, that may be the difference in sitting on the sidelines or jumping in right now. So we're going to take those wins, and let's talk a little bit about where we think the Fed rates are going. And we can breeze through this pretty quickly because it's just everything's a little bit better than the last time we talked, but nothing really new and exciting coming. So we've got our next meeting on March 19th. Rates are not going to change between now and then. Very unlikely that they do anyway, 95%. And it's funny, like I've got charts that are updated like an hour after the ones that we have here now. So like they have changed throughout the day to where mine's actually showing 7% now, showing that first drop instead of the 5% you see there. So it just shows this is a moving target, but no matter what, no one thinks this is going to change in March. So let's take a look at May. And unsurprisingly, still no change in May, most likely. That could continue to change. Like I said, even from this chart to my chart, which are merely hours different from each other, my one drop analysis is showing 31.2%. So we are seeing some trending into thinking you're going to get that first drop in May, but still highly unlikely on a 2-to-1 that we see that. But I think where we're about to see the biggest change is in the June 18th. I've been saying for a long time, I hope we don't drop in June, but we probably will. And this is now showing a much more significant probably will. Looking at a week ago, the changeover rate has increased 7% from 48 to 55. So we are definitely moving in that direction, but trends are important. Trends are always changing. We've got a lot of time before these trends, but I think right now, if I was trying to throw a target on window, I think we're going to see a Fed rate drop. I think it's going to be June of this year, even though I would rather them hang out till July. Let's look at July. I think we're going to see a prevailing consensus that by the time July hits, only 15% are saying we won't have a move by then. So highly unlikely, 85% that we have at least one. But you're starting to see now for the first time a much larger contingent saying we may have a second rate drop by July. I think we're still so far away that we're not going to see the likelihood of that coming in until we get closer to that. But just knowing that it's a possibility, the Fed analysis before the start of the year went from 5 rate drops to 2. and the market reacted really, really negatively at the close of the year. Now, if we can somehow shift from 2 to 3 and we start to feel better about 3 rate drops this year, that could signal good things for interest rates. So I think that's all we have on the charts. I'm cheating. I have more charts in front of me because, again, nerding is kind of what I do. But I did think it was interesting just to share on what I'm looking at here is by the time we get to December, you and I had been talking about this months ago, but the December chart now, the prevailing logic is at 350 to 375. So we're talking about 3 rate drops by December is now, 30%, whereas 2 rate drops is at 29%. So it's not like it's real close, but we've got kind of 50-50 split all over the chart on this one, that 3 rate drops could be a possibility by December. And although rate drops don't necessarily have any direct impact on mortgage lending, the direction that the economy is going, which impacts the need to drop rates, is going to also impact mortgage rates. So I think that's a really good sign for anyone who's interested in the real estate world here in 2025.
Yeah, and it's good stuff to look at. Me and you talked about it 6 months ago, 9 months ago. 5 or 6 rate cuts was the projection for 2025. It went all the way down to 2 was kind of like the max. And like you're saying, if it's 30% between 2 and 3, well, let's just call that 2.5, right? Like 2.5 is their guesstimate now. And
the over under, Vegas going to put us at 2.5.
Yeah, the over under is 2.5 drops. And what I think about from just a layman's perspective, when you say, check it out, we're trending towards more cuts. I know that what I've seen, just glancing at kind of economic news, is, are we in a recession? Look at these numbers from Q1, not as good as we thought when it comes to, the overall economy. That stuff lends itself to more rate cuts. And anybody who's looking at this and just wants to kind of understand the basics, when the economy is sputtering, and there's more unemployment, like that's when the Fed uses the tools that they have, which is, jacking up or down mortgage interest rates, not mortgage interest rates, take that back, the Fed funds rate.
Yeah.
Just think of it as all rates, right? And crank rates down, stimulate economy. Like that's kind of their thinking and how that works. And so when the economy is sputtering, know that is something that is going to, favor rates. I keep wanting to say mortgage, even though, it's
it is what you do for a living. So I'll forgive you because, as in the same line as mortgage rates fall, spending increases. The real estate market is such a huge driver of overall economic health that you can't ignore the fact that as rates go down, people sell, people buy. There's money turning over. When money turns over, that money gets respent. There's upgrades that are being done to homes. I mean, that money goes directly back into the economy in significant swaths. Debt gets paid off. It does a lot to free up additional spending. And that's why there's always going to be some balance. As rates drop to stimulate spending, then you're going to get more spending. So it's a very tight balance. And I think the nice thing that we've seen, at least in the economic data that's been coming out so far this year, is that we're pretty smooth on our transitions, which gets me right into what I wanted to highlight on what's happening this week. This week is a much bigger week for economic data. Friday is a much bigger day. We've got unemployment and non-farm payrolls. And this is where the focus is going to be, especially based on, the stuff missed this morning. We were short on ISM manufacturing PMI. That's why we saw that reversal today. S&P Global was off. Construction spending was off. That missed. So as these spending, indexes drop, how is that going to look for payroll and unemployment? If unemployment and payroll take a jump, that could be a little bit concerning, that things are moving too quickly, that things are starting to regress. And we haven't even really started to see, the layoffs and, the government sector, like we were talking, could be a pretty big factor with the new administration on impacting overall spending. We're talking hundreds of thousands of people. That's going to impact your unemployment rate on a scale that large. But we haven't seen it. The unemployment rate target is still at 4%. Previous was 4%. So, we'll see where that comes in. And honestly, unemployment's low. So a 4% unemployment factor is considered pretty low. So if we are still around there, I think people are going to feel good about it. Non-farm payrolls, are only targeted to increase from 143,000 to 153,000. So these are not tough targets to hit. I'm not anticipating any wild information to come out, but I do think just like last week, we're going to get a vibe on where money is going and how investors feel throughout the week. Because even like Wednesday, which is usually a pretty big day for numbers, we've got S&P Global PMI, ISM Manufacturing PMI. These are things that don't impact your average investor or consumer. But, big money bond movers are going to be paying attention. It's going to be the unemployment stuff that hits on Friday. We're going to see speeches by like all the Fed chiefs, Bowman, Williams, Kugler, Powell. They're all talking on Friday. So we're going to get a really good idea of how things are going. That's another one of those, hey, if you like it, lock it, secure your stuff before Friday. Yeah, it could move either direction or it could stay completely flat. It's not like we're set up for a big miss on Friday. So I'm not giving any huge warning signs to lenders or realtors. I am saying that Friday has the propensity for a very active day in trading, but I don't like Friday movement anyway, because I feel like Friday is a great day for overreacting. And then you're going to see, bonds go overnight, and we've got to deal with European and Japanese bonds before opening on Monday. You can really get caught with your pants down on Monday morning if you didn't take action before all this movement on Friday, and there's just nothing you can do to catch up.
Yeah. And thinking about it from my business's perspective, it hasn't changed. If you like it, lock it. With all of the positive rate movement we've seen over the last few weeks, I'm literally looking at stuff this morning. So this is like, if you're a consumer, if you're a fellow mortgage broker, this is my personal opinion, and take the advice if you want. Like, everything that got into contract this weekend, I'm locking. And there's no real, reason to think that there's going to be a massive amount of improvement and there, be a disincentive to lock. But there's plenty of stuff. And for the people that follow this really closely, the Barry Habibs of the world, like there's some 200-day moving averages and stuff. And there's some resistance to things getting a lot better. And so that's why when I look at it and I'm advising clients, I'm saying, listen, we can get you this 6.875 at no cost. Let's lock it. There's no reason to really gamble unless you're really a gambling person. And, most people I talk to, when it's stated that way, it's like, all right, I'm not a gambling person. And if things get massively better, good news is you're a mortgage broker and we could pick up and move somewhere else. So that's kind of where I want to pull the conversation, Nash, is like, what are you seeing? It's interesting to me to just look at things from a consumer perspective, a home buyer perspective. In my market, I'm seeing the beginning stages, and this stuff all hits like our desk and our phone and our conversations far before it's going to be in mainstream media or anywhere else. But I think it's shaping up to be kind of a what's the right word for it? Competitive spring housing market, in my opinion. I don't know if it's different for you in parts of Texas where you're doing more originating, but what are you seeing out there in the early stages of the spring buying market?
So, I got to ask, if you're accusing me of being a gambler, you see I got dice on my arm. So, I do like to gamble, but I'm not gambling on this stuff like you. I'm locking it if I like it. I think the cool, call to action here and the takeaway is what I went through with my team earlier is like, hey, let's get some wins in the pipeline, because who's winning right now, who doesn't know that they can win? It's going to be FHA and VA buyers from the last year and a half. We're doing refis again. It is not the start of refi season. It is the prep for refi season. In order to make a refinance make a lot of sense for one of those government loans, you probably need to be in the upper sixes right now or higher. I mean, if you're in the low sevens, yeah, all day long. If you got a high loan amount, absolutely. I worked one up this morning. Is a VA buyer that was in a 699. I got him into a 6.25 with no cost. That's not just no points. We're using lender credits to pay for all their lender fees, all their title fees. There's no appraisal. There's nothing else there. And because we're brokers, I have the option to do VA loans without an escrow account, which is super cool. So, they're literally, it was like $3,800 in fees, and I gave them a $4,500 lender credit. So they're almost getting paid $700 to do a refi and saving $280 a month. Like that's pretty awesome. So there's wins out there, and the number of people finding those wins is just going to get higher and higher. And with the ease of doing things like VA streamline refinances and FHA refinances, I think we need to take account of the fact that the advertisements are going to be ratcheting up big time on those, because the national guys, the people that throw out all the trash bait and switch stuff, that's going to get up there. And I think for anyone in the real estate market field or adjacent, we need to be having those conversations with consumers, because we are the ones who know before it hits the news outlets, but not before the trash marketing starts going out there. So we need to be the advocates and the leaders to get the correct information out first and make sure we know what's your strike price. When does this become a good fit? Why should I not believe the, advertisement I just got that shows interest rates at 5.625? Let's go. Because you don't read the small print that shows 2.5 points plus 1% origination fee. Yeah, that stuff's not going to make sense. Refinances are all about math, and I love math. If you didn't know I was a nerd, I mean, I'm a nerd. But math, man, I know. I'm sorry. I can't help myself.
I on math, I nerd out with you. I've got receipts, bro. I've got like all my tests from first and second grade, and a kid who probably needed more love and affection. Like when my teachers praised me for math, it made my love for math even that much stronger. It's a great point you made, and this reminds me of 2019 going into 2020, where rates are coming down. People are going to have the opportunity to refinance, and I just want to double down on what you said. Talk to a professional like Nash, and he's not going to tell you, oh, I can get you a 5.99 just because the 5.99 sounds better. He's going to say, let's go 6.125. I'm going to get you a credit to cover this whole refinance. So it's going to be, for all intents and purposes, a free refinance. You're going to save $280 a month, because you know what happens then? Then there's no feeling of I paid a bunch of money, I baked a bunch of cost into this loan. 12 months from now, 18 months from now, 24 months from now, when Nash can do the same thing at 5.25, now that client just saved $280 a month for the next 2 years. And so $7,000 in extra cash flow in their household. That's great. Pay off consumer debt, do whatever you want with that extra money. And then when a lower rate presents itself, if you would have done the 5.875 or the 5.99 today that cost you $4,000, $5,000, I think it almost holds you back from the next one that likely is coming, versus, hey, we did this for free, right? There's no cost associated with this where you've got a break-even point, you've got to stay in it for 18 months to feel like you got your quote-unquote money's worth. So I love that, Nash, because I literally saw it in person, and I nerded out hardcore in 20 and 21 with the break-even analysis, trying to be a lifelong advisor to people and set it up to where it made sense for them, versus just how do I win the deal that's on the phone? That's what you get from somebody who's in a call center and selling you a refinance. So heed that kind of warning that was stitched in there from Nash. There's going to be a lot of mailers. There's going to be a lot of phone calls. There's going to be a lot of advertisements. The way that they've learned in the call centers to grab your attention is to throw out a rate that sounds really fancy and hope that you don't ask, look for, or notice $15,000 in cost in box A. That's not loan advising. That's not proper loan structure and, somebody who's looking out for your best interest long-term. That's just somebody trying to sell you, put another check mark up on the board and get closer to whatever, metrics their sales leader put up for their team there in the cubicle. So end rant, talk to a professional, greatmortgagebroker.com. If you come to me and you're looking to do something in Texas, I'm going to send you to Nash, because Nash will nerd out and help you out structuring that stuff. So yeah, that's what I have to say about that. As far as purchases go, though, Nash, I'm interested in your market and some of the different markets you're working in Texas. What are you seeing? Because I think people are waking up because of the time of year. The sun is coming out. It's kind of a nice time to home shop. If this spring home buying season just happens to align with some decreased mortgage rates, which lends itself to more affordability, like you mentioned, maybe somebody qualifies for $20,000 more. What's going on in your neck of the woods from a purchase market standpoint?
Yeah, same. And what's going on. Like exactly what we expect, and this is the time of year, again, back to call to actions for anyone watching this, especially on the lending side. This is the time to, touch base again with those buyers from fourth quarter of last year, from third quarter of last year, because with affordability increasing and interest rates going down, that sweet spot between, I'm a buyer with leverage. And right now in my market, buyers have leverage on anything that's listed. There's not a ton that's listed out there. But as interest rates fall, we will see more listings. More people will be willing to move up, take the next step. But also as the spring market comes and it's a better time to sell, we'll see more listings, but not as quickly as we will see more buyers. The supply versus the demand, the need for housing versus the need to move up are out of balance, and will continue to be out of balance for years, if not decades to come. This is a long-term problem that, we've talked about before. There's not enough new construction to help people get into housing. So therefore we have to keep recycling existing homes. So we're going to see, it's just the start of it. This is honestly like the first week of getting into the spring buying season. So I've seen my realtors' marketing strategies change. The conversations I've been having with buyers have been more frequent. People are starting to get on deck, and it's that combination of higher affordability plus a little more flexibility that we're also going to have to prep people and understand that, hey, 3 weeks from now, you may not have that same flexibility. You may not have that same leverage. You may have 4 people trying to buy this house, and you may not be the most competitive. We haven't had to have that conversation with people in a while. And while that's a hard conversation to have, it's not necessarily a bad thing for real estate professionals, because that means we're getting into a market where there is more competition. And as there's more competition, you'll start to see more sellers come out because they want a part of that. They feel like, hey, I can get some more stuff. So the market will always intrinsically balance itself. And, it's just usually not in the right kind of timing. So you got to find those little blips, but ultimately you can't worry too much about that. If I'm talking to a buyer and they're excited, yeah, I may be trying to get them to move a little more aggressively right now as rates are falling. If they try to time that fall just right, then they're going to be competing with more buyers. But when they're competing with more buyers at a certain point, that means we're going to have more listings. So I think trying to overthink that is a bad game to play. You can wind up losing when there's no reason to lose. If you find something you like at a price that you can afford and an interest rate that works with your own comfort, this is your home for most people, especially if you don't own right now. Just getting to the game is the most important spot, and not trying to do, analysis paralysis and talk yourself out of making a move.
Yeah, agreed. Has the house you left, is that one sold yet?
No, Matt, it hasn't. I promise you will know as soon as I have a good offer on my house.
Okay. Well, and I apologize for picking at the scab and bringing up that. I was curious, what came to mind was a good conversation I heard about, part of the problem and part of the reason why we're not going to see a solve for our inventory shortage is for every baby boomer that's moving into assisted living or passing away, and a piece of housing inventory is added to the market, there's also plenty of call it millennials or other generations that sometimes they move and keep the house that they left before.
It's being a lot more common right now. We're seeing a lot of people moving up into their parents' homes as opposed to selling them, because their parents' homes are more of an upgrade than what they could afford at that time. Plus, a paid off home just sounds really good right now. But to your wound, picking there, my house is incredibly unique, and it's expensive. It's almost $2 million in Texas, and I'm only appealing to cash buyers right now. Most people don't want to finance that much, even at 7% interest rates. I wouldn't spend that much for that house, and I didn't, because I bought it a long time ago. So, unique properties are still going to sit on the market for a while. I knew 6 to 9 months was about normal. And, I'm at the 8-month mark right now. So it took my neighbor a year to sell. So I'm going to continue to be patient and wait for the right buyer. I have had a few offers though. So things are starting to pick up there. But
yeah, I bet you
stuff is good.
Yeah. The spring's coming. More buyers are going to be out and ready to move. And, the buyer that's right for that house will come along. So I think you're going to be in contract before the end of March. I'm just going to call my shot right now.
Okay. Hey, I'll take that. My wife will be really excited.
Yep, for sure. I'm sure 2 mortgage payments isn't
not ideal
for the Paradise household, but yeah, dude, it'll be interesting to watch as this spring buying market unfolds. We'll be here every Monday to give our insight to the people. So thanks for anybody who joined us. Leave comments, whether it's live or post production, I'll jump in there and try to answer any of those. If you want to get in touch with either one of us, you should be able to find us on the interwebs. We're not undercover loan officers. You Google Matt the Mortgage Guy or Nash Paradise the Loan Wizard. I'm sure you can track us down. So thanks for watching. I look forward to chatting with you again next week, brother.
Thanks, man. Can't wait.
All right, later, dude.
Take care.